SSR Mining presenting with us today. We have Paul Benson. He is President and CEO. Paul has been at SSR Mining since 2015 and has more than 30 years experience in the various technical and business capacities. Previously, he was CEO and Managing Director of Troy Resources. Before that, he spent 20 years in executive and operating roles in Australia and overseas with BHP Billiton, Rio Tinto, and Renison Goldfields. He has degrees in geology and exploration geophysics, engineering, and is a graduate degree in applied finance and investments and another in management. We also have with us Stacy Pavlova, Management Investor Relations.
Okay, thanks very much. That was a very impressive presentation from Larry at one level. At another level, it was actually very depressing in terms of the world it paints. What I want to do today is go through our presentation, SSR Mining. It's quite a detailed presentation. You should be able to see it on screen. You'll be able to download it from our website later this afternoon. Quite a few slides in there because we cover a large number of areas, but I'll tend to go through them reasonably quickly. So just making sure the standard disclaimer. Just an overview of the company and what really distinguishes us compared to most of our peers. We've continued to meet guidance, 7 consecutive years where we've met or exceeded guidance both in terms of production and cash costs, and we've said at the midpoint we're on track for the 8th consecutive year. We have a good track record of reserve growth. We're also in a period of strong production growth, and I'll show you the data behind these. We're diversified. We're not just a single asset company. And the 2 key assets are in what are ranked the 2 best jurisdictions for mining investment, Nevada and Saskatchewan. Peer-leading corporate governance, and I'll talk to that. Track record of adding NAV per share. Very strong liquidity, dual listed on the TSX and NASDAQ, and a very strong balance sheet, and which we've continued to build. Just an overview of the company. You can see where the assets are. The orange dots are the mines. So from top to bottom, CB, which is in the north of Saskatchewan, that's a small tonnage, narrow vein, high-grade underground mine. The middle one, Marigold in Nevada, very large, low-grade open pit. And the one down the bottom is the Puna joint venture, which is a large open pit silver operation. You can see some headline numbers there. We'll do about 400,000 gold equivalent ounces this year. About 80% by revenue is gold, 20% silver. Market cap in the order, or just under $2 billion US. All the dollars we talk about today will be US dollars. That's our functional currency. This graph, page 5, gives you an overview and feeling for the momentum in growth within the company. This is measured in gold equivalent ounces. So the bar at the bottom is actually the silver mine in Argentina converted to gold equivalent. Up until 2018 or 2017, that was our 100% Paquitas operation. Going forward, that's our 75% interest in what's called the Puna joint venture. We opened the original mine back in 2009. The middle bar is Marigold. We bought that in 2014. The top bar is CB. We bought that in 2016. You can see from last year, which was really what we call the year of transition, as we were bringing the new deposit online in Argentina. Between last year and 2021, a near 40% increase in gold equivalent ounce production. The nice thing about that increase in production is predominantly driven by higher grade, so it's not through the addition of large amounts of extra capital. In addition to the increased production, you can see the drop in the cash cost. So you're getting margin expansion across a large number of units. This is the balance sheet, the cash position, something we're very proud of. We started with a strong cash position back in 2014. We put in place the first convertible note in 2013. We used cash to acquire Marigold, and we continue to have built that cash position. It came off a little in 2018, and that's really as we were building the new mine in Argentina. But we moved back now into a cash accretion period. We've got a track record of adding value through M&A. M&A is obviously a subject that investors rightly are wary of. There's a very good history and track record through the industry of destroying value through M&A. We have a good track record of adding value. Here we show the 2 main mines which we've acquired. So for each mine, the bar on the left talks to the acquisition or announced price. The bar on the right is the value to our shareholders, a combination of the cash we've already taken out, the consensus valuation from the brokers, and an indication there's still upside to come in terms of exploration. So you can see really good results of both. CB doesn't look quite as spectacular as Marigold, but it's only been in the portfolio for half as long. So I'd hope in another 2 years' time it would look very similar to Marigold. When you add it all up, this is NAV per share of us in orange compared to the peer group listed at the bottom, and you can see significant outperformance. And that's a combination, first of all, of good acquisitions, then running the assets harder, and then investing in and having success with brownfields exploration and continuing to replace reserves. These graphs just show that track record of meeting or exceeding guidance. So the graph on the left is production, graph on the right is cash costs. We've done it for 7 years in a row, and we said at the midpoint of this year we're on track for doing it for an 8th consecutive year. So the guidance for each of the operations, what you see there is for each mine, the range we've given at the top, and that's an updated guidance. We've improved guidance slightly at some of the mines, or each of the mines, and the orange number below it is where we were at the midpoint. So you can see that Marigold, the midpoint would be around 212,000 ounces of gold, and we're about 108 at the halfway point. If we get that target, it'll be a new record for that mine. At CB, the midpoint of guidance here, 105. If we get that, that'll be a new record for that mine, and we're well over the halfway point at the halfway time. At Puna, it'll be a new record because this is the first year of operation for Puna, and we'll do around 7 million ounces of silver. So all up around 400,000 gold equivalent ounces, cash costs in the low 700s. And you can see for each operation, the sustaining capital, the capitalised stripping or capitalised development if it's underground, and the amount we're spending on exploration at each asset. Just a couple of things on ESG. We take it very seriously. So we produced our first ESG report earlier this year, and it's available on our website. Some of the key metrics that we're focused on, just because of the jurisdictions we're in and the locations are around the communities in which we operate. Some key numbers for us, which we're proud of. At Puna, 50% of the employees are from local communities. When we opened the new Chinchillas mine, it was 100% of Chinchillas. Also at Chinchillas, 30% female. I think that's the highest proportion of any mine in Latin America. You can see also in the mine in Saskatchewan, Indigenous employees and what are termed northern employees are key metrics that we focus on and we score very, very well on. So something we're very proud of. The other thing we're very proud of is the straight governance score. We get ranked by ISS, which is the key proxy advisor. They have a scoring system of 1, best, 10, worst. And you can see if you score an overall quality score of 1, you're allowed to put that banner on the top of on your website, which we do and we're proud of. We've scored consistently 1 for quite a few years. What you can see, our scores across the top there, the subdivisions that the ISS look at, compared to the peer groups below. One area of focus in our industry, and rightfully so, has been executive compensation, and probably highlighted most famously by Marcelo Kim, gave a presentation at Denver 2 years ago, I absolutely agree with him that some of the levels are extremely excessive. You can see we're the only company that scores a 1 on the ISS system for compensation, that third column along. There are no other 1s, there are no other 2s, and the averages are much higher. I'll talk briefly to each mine. Marigold, this is in Nevada, large, low-grade dump leach operation. It's a Carlin-style mineralisation, which means it's low-grade, disseminated, sedimentary hosted gold. A couple of interesting and important facts about the mine. It opened in 1989 with an 8-year mine life. This year celebrates its 30th anniversary of continuous production. So it's been in production even during the low gold price of the early 90s. Managed to keep on going. At the beginning of this year, had a 10-year mine life, and I'll talk to the exploration success we've had and what we still have in front of us. So I'm quietly confident in 10 years' time it will probably still have a 10-year mine life. The graph on the left shows the forecast production As I said, if we get that midpoint 213, that will be a new record, which obviously is impressive at any time, but for the year of its 30th anniversary, even more so. You can see the production increasing in the years up to just below 270,000 ounces. The mine life goes out when we put this reserve out to 2028. Sorry, we just had a freeze on our computer. We're just going to play with something. The webcam is frozen here, and now it's pointing up. Okay, whoever's steering the webcam, probably do it now. Okay, sorry about that. Technology outside of our control. The graph on the right looks at our reserve position. You can see the banner at the top, 0.47 grams a tonne is the average grade, so low grade deposit, but we still make very good money, very good cash, even at that low grade, because it's a low cost operation. We bought the mine early 14. At the end of 14, we had 2.3 million ounces in reserves. Since that time, we've mined over 1 million ounces from the reserves, but we've added back over 2 million through exploration. So at the beginning of this year, we've started with 3.3 million ounces, which is almost 50% higher than when we bought it, despite having mined 1 million ounces. You can see also we have 5.5 million ounces in measured and indicated resources, which include reserves. So there's over 2 million ounces currently in M&I, not included in reserves. We focus and we talk a lot about continuous improvement at each of our operations, what we call operational excellence. This just gives you some sort of hard data behind that, and this is looking at productivity around the rope shovel through different initiatives. There is a graph you'll see in our Denver Gold presentation, which we've used before, but we're updating, that looks at the productivity of our shovel compared to similar shovels around the world, and we are in the top 10% in terms of productivity. We have continued to invest in brownfields exploration and also expand the footprint. So what you see on this slide is the picture on the left is when we acquired the mine back in 2014. That was the original Marigold property. Goldcorp, who used to own Marigold, had always wanted to acquire the Valmy properties, which had been operated by Newmont. Newmont would never sell to Goldcorp. They considered them a competitor. In 2015, a year after we bought Marigold, we bought Valmy. Newmont were comfortable selling to us. They didn't see us as a competitor. That's brought resources and reserves into the Marigold fold. In 2018 and early 19, we picked up some of those smaller yellow blocks, and then earlier this year, or a month or so ago, we announced the acquisition of Trenton Canyon and Buffalo Valley off Newmont. So you can see the increase in ground position from originally 7,900 hectares to over 19,000. So a significant increase in the land position. Where we are exploring at the moment, this is a long picture just of the Marigold property. From bottom to top is around 5 kilometres. And if you consider the endowment here, if you look at what's already been mined and what's still in the ground, this is a 12+ million ounce camp. So it's big even by Nevada standards. We're mining in that grey area at the moment, and last year and this year we're drilling in that area called Red Dot. We've indicated Red Dot will move into reserves when we next update the report, and that will push the mine life from the current quoted number of 2028 into the early 2030s. We're drilling around Valmy, Basalt Antler at the moment, and we also will start drilling on this Trenton Canyon and Buffalo Valley ground. There are resources in situ, but they're not compliant, 4310 compliant, so it's fairly simple work that we have to do. We have to do some twinning holes and some quality QA/QC checking, but we're confident a reasonable number of ounces will move into the reserves and resource statement early next year when we update that. So very, very confident that over coming years we'll continue to invest in brownfields exploration and more than offset depletion for the near future. Going now to CB, this is a mine in Saskatchewan. This is narrow vein, high grade underground. This is actually a waterlock site, so we fly in, fly out most of the time. The only way you can get here on by heavy vehicle is over the winter road. So each February, March, we bring all the heavy supplies and bulk supplies across the winter road to that operation. This is a grade story. The average grade of the reserve, 9.2 grams a tonne. Because it's steeply dipping narrow vein, you've got to take into account inferred. So if you look at measured, indicated, inferred, there's over 1.3 million ounces. We've already doubled the reserve since we acquired it in 2016. This is the production profile going forward and has been updated to take into account our most recent guidance. Some useful numbers to think about. We bought the mine back in 2016. The year before we bought it, the plant averaged 860 tonnes per day. Last year, we averaged 960 tonnes per day. We're assuming going forward, we'll do 1,050 tonnes a day. So that ramp up in production in the dark blue bars are a combination of increased throughput and also increased grade. The rest of it in the light blue is just changing grade. And you can see increasing production and decreasing cash costs. This is a great example of continuous improvement at this site. This is a data plot showing throughput through the plant, tonnes per day on each dot of those is a 24-hour period. So you can see that great trend. As I said, the year before we bought it in 2015, 860 tonnes a day. Last year, 960 tonnes per day. And you can see a peak period there of 1,400 tonnes per day. The great thing about that graph, that improvement, that's been done with practically no capital. That's just operating the plant that was there more efficiently. The only negative thing about that graph are the number of dots below the green line, and that's showing that the mine can't keep up with the mill. And so we've moved the bottleneck from the mill back to the mine. That problem is relatively easily solved and would have been solved last year. If this mine was in Nevada, we would have bought new equipment, driven it down the highway and put it into work. But because we're at the end of the ice road, we had to wait until February, March to bring that equipment across. So we brought in 2 new trucks, 2 new loaders, and they started working Q2. So the initial impact of that will be felt in the development rates, how quickly we can tunnel, because you've got to get the tunnels moving ahead of the stopes. But this gives you a good example of the improvements we've seen at this site in terms of development. So you can see two step changes. The first was really just in terms of improving coordination and processes that they used at the mine. And then you can see since we brought the new equipment in, we've seen a step change in development again. That will eventually flow through to ore production, which should reduce the number of green dots on that slide, or the dot below the green line, and lift the average production up. This year's budget is 1,050 tonnes per day. I'm hopeful that if you look at the end of next year, it will start with an 11. It will be 11 plus 100 tonnes per day. This is very much a grade story. This is a long section through what's called the Santoy mine. This is the only mine we're operating on the site at the moment. It's colour-coded, and you can see the code or the legend down the bottom right. So anything in that dark red colour is over 20 grams a tonne. Average reserve grade, 9.2 grams a tonne. Still open at depth. You can see an area, I'm not sure if the mouse will actually move across. Yeah, I'll just highlight an area in the middle here. It's called the hanging wall zone, that white area. That's not currently in reserves. We put 90,000 ounces in resources. We indicated with an exploration update a couple of weeks ago that we've had good success there. It extends both up and down plunge, and we expect to add more of that into resource and hopefully some into reserves next year. So again, we've already doubled reserves since we have owned it. Current mine life goes out to 2024, but we're very confident we'll continue to add to the mine life. The budget we've had here is this year is $6 million US. About a third of it is on this page, and anything on this page will just extend the mine life. 2/3 is looking for something else. and this is looking for a new deposit. This is a plan looking down on the property. The yellow outline at the top is the ground that the company we took over, Claude Resources, owned. So similar to Marigold, after we bought the initial property, we looked to see what other ground we could pick up. That ground to the south, that larger area called the Fisher joint venture, we entered into that the year after we bought the mine. The reason we wanted to do that is that red line. That's called the Santoy Shear. That's the fault or plumbing system that brought the gold into the, that formed Santoy. The best place to find a new high-grade gold deposit is near an existing one and on the same structure. So we're spending 2/3 of the budget, $4 million US this year, looking for a new deposit. There have already been 2 1 million ounce discoveries on this property, so we, obviously looking for a third. One bit of history which is important to understand, the perseverance you need on a project like this. Santoy was originally discovered as a small outcrop of quartz about a foot across. They channel sampled it. It had some gold in it. They had to wait to winter to drill off a frozen lake. They came back, drilled it, found nothing. Came back the second year and drilled it and found nothing. If they'd given up then, they would have missed a 1 million ounce discovery. It came back the third year and hit high grade. An excellent outcome from that, and that really teaches you that you have to persevere. As much as we'd like to announce a new discovery this quarter, we'll be drilling here for another 4 or 5 years. There's over 30 kilometres of strike length here. And in terms of size and impact, if it's small and high grade, we'll just truck it back to the existing plant. If it's larger, so I think say a 1 million ounce hurdle, we would then look to either expand the existing plant or build a new plant. But so still a very good future ahead of CV. Puna is the third mine down in Argentina. This is a silver open pit mine with some base metals. It's currently a joint venture, 75% us, 25% Golden Arrow. We're in the process of buying their share out from them, the 25%. That we made an offer to them, which their board has recommended to shareholders. That's going to shareholders in mid-September. If we get the requisite vote there, we will then have 100% of this operation. This shows our 75% share of production. The mine life goes out to around 2025. This is done as silver equivalent, just so you can understand the impact of the base metal byproduct or co-product. So the base is silver, the middle bar is lead, top bar is zinc. When we report, we actually report silver net of those byproduct credits. So fairly steady production going forward there. There is certainly some exploration upside, and we will commence some drilling there in the fourth quarter of this year. We still have some projects embedded in the company. One of them is Pitarrilla, one of the largest undeveloped silver projects in the world. Originally considered as a large, low-grade open pit. Back in 2012, we didn't go ahead with that when the silver price dropped. Last year, we dusted it off to see if we could come up with a smaller project, lower capex, focused on the high-grade underground. We said we'd be disciplined. We would only do it if it had a double-digit IRR at spot price. And spot price, as you would be aware, last year was under $16. Didn't quite get there. It was NPV positive. We said we go back and have a look to see if there's anything else we could do. And what we identified was that because it was originally conceived as a large open pit, drilled from surface with vertical holes, the high-grade mineralizations tends to follow vertical veins. So quite likely that vertical drilling from surface missed or underrepresented the amount of high-grade material there. So what we're doing at the moment is considering, there's a decline put in partway towards the ore body back in the 2000s. We're looking for proposals now to extend that decline and then put a drill drive in and do horizontal diamond drilling. The aim would be to identify more high-grade material. It was single-digit IRR before, so it wouldn't take that much to push it to make it economic. We're currently doing reviews of the tenders we've had from mining contractors to put that decline in. We'll make a decision before the end of the calendar year. If we go ahead, ballpark number would be something like $10 million for the contract, for the extension of the decline and the drilling, and it would probably take 18 to 24 months to get to a point where you've analysed all the drilling and updated your reserves and decide whether you go ahead with a pre-feasibility. The nice thing about this mine plan is it doesn't sterilise the surface. So in total, high-grade underground and surface is over 500 million ounces in the current reserves and resource. So it is one of the largest undeveloped silver projects in the world. So watch this space with that one. Something a little more closer to commercialisation is we have an interest in Silvercrest. They have the Las Chispas deposit. We have just 9.9% of that company. It says there 9.6. We're just picking up the remainder. Our average entry price of that position is around $3.90, and they're currently trading in the $7 range. So we've done well with that. We're working with them, and we'll determine whether we try and increase our interest there or not. But either way, our shareholders have and will benefit in the future, I think, from exposure to that very, very high-grade project. So that's where we are as a company. We've got very solid production. We're in a period of organic growth. Management discipline, we continue to do what we say we're going to do. We're financially conservative or prudent. I'd say best-in-class balance sheet. And there's good upside at each of the current operations, plus some projects embedded in the portfolio as well. So with that, I'll leave that. That's the end of the presentation, and open up to any questions you might have.
Thank you, Paul. Very well presented. We're going to turn to our investor questions now. We're going to start with Chesley Morton. Chesley, any questions today for Paul?
Okay, can you hear me?
We can indeed.
Okay, that's great. So we're hopefully in a longer-term rising commodity price environment. And so with regard to CB, or the project in Canada, gold project, how do you respond to that? Do you lower your cutoff grade and expand your resource and your mine life, or do you keep going on as usual and just keep that in reserves?
Good question, and every mine is different. And so I'll answer it in two parts. CB, it's structurally controlled, so it's not as though you're moving necessarily from high grade to low grade, but you do have areas of low grade within the structure. So what is lower grade currently isn't in reserves, it's in resource. If the gold price was high, you'd probably tend to just tack it on to the end of the mine life. You'd need a significant amount, more than we currently have identified, to worry about an expansion. So I think it would just tend to push out the mine life. Marigold is different. That's a dump leach operation. So you don't have the same bottleneck, but we're already mined to an extraordinarily low cutoff grade there. The cutoff grade, once it's in the truck, is 0.065 grams a tonne, which is sort of near detection limit. So hard to have a big impact there. Obviously at Pitarrilla, we're focusing on the higher grade underground, but we know the open pit worked at $25 an ounce silver. So the nice thing about that configuration we're looking at is starting with the high grade underground won't sterilise the open pit material, so you can always come back and mine that in parallel or at a later date. Just the other part of the comment I'll make is that you don't want to be too quick to change cut-off grades, etc. Quite a few people, fund managers and investors, have criticised the industry and the CEOs leading the companies for when the prices rose before, making investment decisions assuming that they were going to continue ad infinitum, and then and applauded them when they did, but then criticised them when the price went back and people had lower grade projects that they were operating. So it's something that we are good mine planners. Something we do understand and focus on, but it won't have a dramatic effect in terms of reserve or resources in the short term, but it obviously improves the margin.
Okay, well, that's a thorough answer, and I appreciate it. One other question with regard to your very strong financials. You've got $450 million, and you'd be in a pretty strong position with half that. And we're still, yeah?
Yeah, no, sorry, go on.
Okay, and we're in an environment where there are still a lot of bargains out there. Are you tempted to maybe be more aggressive with regard to your acquisitions, expecting that maybe we're in a long-term rise in commodity prices and overall pricing of mines?
Yep. Two things just on the balance sheet. I just moved through the appendix. We don't have any straight debt. We've got an undrawn debt facility. We do have two convertible notes out there. So the net cash position is about 220 odd, $200 plus million. So the gross number is 452. The net will pay off the 2013 convertible in February next year, 115. The 2019 convertible isn't due until 2027. So we've got plenty of time. We don't need to worry about that. So very strong balance sheet. Again, we are very disciplined with M&A. There are only two ways to find new ounces. You can either drill them, which we do, and you can buy them, which we have. But more value has been destroyed through M&A than has been created. I think most of the studies show that, but particularly in gold mining. So we are disciplined. There's some interesting stats. So we've done 5 or 6 deals in 5 years. We bought Marigold first, then the adjoining property Valmy, then we did the earn-in option down in Argentina to extend the life there, then we bought Claude. We've since bought Trenton Canyon, and we've taken the equity position in Silvercrest. Since we bought Claude, we've looked at 12 opportunities now under CA, and 10 of them we said no to. And that's for a couple of reasons. One, the market was overvaluing them, in our opinion, and so there was no room for a premium. Or in other cases, they were just bad projects, and the market had no idea. We understand that you're only as good as your last deal. Very easy, very hard to earn a reputation, but very easy to destroy it. And as I say to our team, I'd rather miss a good opportunity because we're conservative than to buy a bad one. So we may have missed 1 or 2 good opportunities, but we're batting 5 for 5 at the moment. So looking into the market at the moment, obviously rising prices lift all boats, and it's hard to see a lot of value there for the types of things we're looking at. But we continue to look at any period of time. We'd have 2, 3, 5 confidentiality agreements. So I say to our shareholders, I guarantee you we're looking. We look with the same discipline. Don't be surprised if we do buy something or announce something like Trenton Canyon, but that was a good add-on, a bolt-on, low-cost acquisition for us. But we look also for anything from operating mines. So if a big company wants to sell one, merger of equals, all the way down to exploration projects, and continue to look.
Thank you, Chesley, for your question. We're going to turn now to Chip Richardson. Chip, questions today for Paul?
Seems to me that the operation in Canada is probably a lot more expensive to expand than the Nevada operation. Is that correct?
Yeah, absolutely. It is a milling operation, and so the bottleneck at the moment is the mine. We might be able to squeeze another 100 or 200 tons a day into the mill. After that point, you'd have to justify a new mill and new crusher. And so that's a big step change. And that's why I was saying we'd only worry about that if we discovered, say, another million ounces. Anything we discover short term will just add on to the mine life. So, that would be a nice problem to have. At Marigold, it's more incremental. It's more incremental. You're just adding leach pad and mobile equipment.
Yeah. What do you see in Argentina? Are you concerned about the recent election there? And what's your experience with Argentina, the political situation?
We've been operating there for 10 years. I've been working there for over 10 years. When we built the original mine back in 2009, in 2015, we knew we were coming to the end of the mine life, and that's when we did the option deal with Golden Arrow to earn into their Chinchillas project. And we now own 75%. That was a marginal investment. Our share was $60 million, and that extended the mine life by 8 years. and really why it was attractive, for $60 million, we were leveraging sunk capital. What I've said is we would never go and build a brand new mine from scratch. So to build that operation today, mill included, would be over $500 million. We wouldn't do that. So in a way, the way I think about it, we're already pregnant in Argentina. This is a marginal investment. We're comfortable with that exposure. What happens there, I don't know. Even during the Kirchner years, we were able to move currency out because we have intercompany debt and also a concentrate producer. It's a doable. It wasn't an issue. At the moment, there are no currency controls, and it's running very, very smooth economy. Like everyone, will watch this space and see what happens in the real election. That was just a primary they had. Obviously, it impacted the currency, which has a beneficial impact for us. And then, we'll all sort of wait and see to October to see what the final result is.
Thank you, Chip.
Thank you. Very nice. No, just a very nice presentation. Keep up the good work.
Thanks very much.
Thanks for being on the call, Chip. We'll turn to Chris Mulcahy. Chris, unmuted. Okay.
Paul, I'm worried about you with a high rating on pay to management. I'm afraid you're eating too much tuna fish, and I'm worried about you. That leads to my real question, which is, could you talk about your management style? You've got a lot of spinning plates here, and obviously you are crunching numbers all the time and attempting to motivate your managers to increase production and whatnot. Could you talk a little bit about your style there?
Sure. I just moved the presentation back a page. This is, again, in the appendix. The top, above the bottom dotted line is a management team here in Vancouver. We've got a small office. I used to joke that we had fewer people in our head office than Goldcorp had vice presidents. I can't make that joke anymore because Goldcorp doesn't exist. But a very lean operation. We've got under 40 people here. I've got 4 direct reports. They're all good experience within the industry. Just in terms of backgrounds, Nadine, HR from a variety of mining companies, Johnny DeCoomans, business development and investor relations, number of mining companies, Greg Smith, ex-Placer, Kevin O'Kane, I used to work with in BHP. So a good team. Each site is different. Each site has their own management team, and you tend, because they're localized, you tend to hire out of Nevada for Marigold and, out of Saskatchewan for CB. In Argentina, we only have 1 expat, so we're looking around Argentina and Chile for locals there. For me, I'm absolutely driven by creating value for shareholders. I'm a paid manager. That's my job. I know a lot of investors ask, how much do you own of the company? And I understand why people ask that, but I think it's the wrong question. I think if someone gets up and boasts how much they own of the company, it's normally because they're an exec chairman who started the company or and gave themselves a lot of shares to begin with. We have a lean operation. I think the people who work for us, have the same values that we're here to create value. We get enjoyment from doing better, and that's the whole ethos of continuous improvement. No matter what you're doing, you can get better. And over recent years, we've been able to hire some good people away from some bigger companies because they look at what we're doing. We pay market in terms of median salary. We don't go overboard with the incentives or anything else. And people want to be part of an organisation that they can see is growing and doing the right thing.
Do you pay bonuses? Do you require managers to purchase stock?
Yeah. No. So why we score highly on the ISS ranking around compensation, a number of things. The base isn't absurd. It's median. That's what the policy tends to go for, is median. The long-term incentive is totally aligned with shareholders. So at the moment, it's 50% options, which obviously are worth zero if the share price goes down, and 50% total shareholder return. relative total shareholder return. So even if the share price goes up, if we're in the bottom tercile of relative TSR, we get zero. So very much motivated by that. Each of the senior execs is required to have a level of shareholder ownership, which is, depending on the level, is a multiple of your base salary. And all except for Kevin, who only joined last year, we're all above those levels. We don't have any RSUs, so that's one of the things that I agree with ISS. Is not a good mechanism. An RSU, the joke is you turn up and breathe, and it ends up paying out. So any of that long-term incentive is totally driven by performance.
Thank you very much.
Thank you, Chris, for your questions. We'll turn to Jerry Needleman. Jerry, questions today for Paul?
Hello.
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 We can hear you, Jerry.
Okay. Paul, very good. You mentioned in your great presentation all the things that you're proud of, and you mentioned that many, many times, those words. All I can say is I'm also very proud of this company and what you guys have been doing, and really proud to be a stakeholder. This is one of my biggest positions, and anybody on the call, I recommend, if you believe in what's going on right now in our world here and with precious metals, SSR should be a core position in everybody's portfolio.
Thank you, Jerry.
Yeah, thank you very much. Kind words. I would add two things. One, and it's because having run a smaller company before where I ran into a lot of retail investors, I just reiterate everyone should be diversified. And two, as much as we, our objective is, very clear, I am a firm believer in that there's an element of luck in it. I like Gary Player, who said the more you practice, the luckier you get. But I do also understand that there's an element of luck in there.
And if things can turn against you, like the market, right? And you've done very well with difficult market conditions.
Yeah, and you are only as good as, unfortunately now, your last quarter. So everyone through the organisation understands, that we have to deliver on what we say we're going to do. So we take that. We don't try and over-talk the stock. We don't try and over-promote. We say this is what we expect to do next year, and that's absolutely what we're focused on.
Thanks, Jerry, for checking in with us. We'll turn now to Lincoln Rathman. Lincoln, questions today?
Hello. I have a very quick question to follow up on Chip Richardson's question. If a giant fissure were to open in the earth and Argentina would disappear below the seas, what percentage of the value of SSR would be lost?
Well, on the revenue basis, it's 20%, but on a cash flow basis, it's significantly less than that. In terms of net asset value, I'm not sure it would be what the brokers have, but it would be definitely less than 20%.
Okay, so 10 to 20% or something.
Yeah, well, I mean, on a revenue basis, which the margin isn't as great there as it is up there. If you forget all the other assets in the company, but if you add up all the other assets like cash and Pitarrilla, I assume it's under 10%.
Okay, thank you.
But I don't want that. I just say I don't want that to happen, because that would also take the best beef and Malbec out of the world.
Over to Nino Scalamandre. Nino, do you have questions today?
So on the gold project, very impressive grades. Just can you give like a 1 minute overview of how these grades are so good? Are you chasing quartz veins, or is this just the nature of that deposit?
Yeah, we can take zero credit for the grade there, other than identifying it. Before we took them over, we knew this was high grade. It's one of the highest grade deposits in Canada, and it's a quartz vein hosted lode system, so is open at depth. There is quite, you saw on that slide, the long section, there's quite a variation in grade. Our cut-off grade there is, I think, around 3.5 grams, so anything above that we'll put through the mill. But yeah, it is just a naturally high-grade geological system.
Thank you.
Thanks, Nino, for your question. We're going to turn to Bill Borman. Bill's got a couple questions from investors that are on the call but don't have speaking function. Bill Borman.
Okay, yes, hi. The first one comes from Howie Flinker. He says, presuming that the market for gold and silver has changed and the 8-year bear market has reversed, why aren't you more aggressive on acquisitions? First part. Second part, looking backward on the old criteria will leave enormous opportunities on the table. Those will cost 3 to 5 times today's prices in 3 to 4 years.
Absolutely right on both cases. If you go back to Poulsen's, Marcelo Kim's presentation at Denver, where his main criticism was executive remuneration, but he did this great correlation between executive remuneration and the size of the write-downs that companies had done. So, the biggest write-downs, the biggest executive compensation. The write-downs were caused by building and buying things, assuming the gold price was going to be higher for longer. And so, the gold price has run in the last, last 2 months. Before that, most brokers had their consensus at somewhere between 12.50 and 13.50. It's happened very quickly, and so you can only evaluate acquisitions based on what you think is fair and reasonable and is in the best interest of your shareholders. So certainly, if we bought something 2 months ago, no matter what we bought 2 months ago, it would have been worth more today. Fact of life, you can't get away from that. But similarly, if you bought something today and the gold price went down, then I'd certainly be getting lots of criticism for the big write-downs we'd be taking. So we evaluate things using a number of metrics, using a number of different gold prices. We continue to look, but even when we put in, we looked at one recently where we put in spot price, so 1,500, and in our view, it's still trading at 2 times NAV. So then you say, you've got to bet that over the life of that model, you're going to be getting $1,700 gold just to get a return on capital. So I understand the frustration that people aren't making as many acquisitions, but I think management and CEOs have been criticised so much over the last 6-7 years that probably they're a little gun shy as well.
Gotcha. Thank you for that. The next question is, do you have a contingency plan if Macri loses in November?
It's just run out the ore body. That's why I said this is really just a marginal investment to leverage sunk capital. There's not a lot more capital to go in it. So, worst case scenario, I don't know what the worst case scenario is, but if currency changes or exchange controls change, we'll continue to operate for as long as we can. But we won't put any more money into it. But we'll wait and see. On things like that, I'm generally optimistic. So I'll lose sleep over that next year, but certainly not this year.
Gotcha. Okay. Next question has to do with hedging. Have you ever considered hedging with gold where it is today?
No. Our view is, that people invest in us for exposure to precious metals. If we were to hedge, why invest in a gold or silver company? The times where personally I'd think about it are, if you're starting up something new and you need to ensure a payback of a debt facility or something like that. So the answer generally is no. We do hedge some of our input costs, so diesel for Marigold, some Canadian dollars for CB, a few other things. CB is naturally hedged because we have to take everything across the ice road, so we buy everything in December before we ship it across. But yeah, we don't hedge the precious metals.
Gotcha. Next question. Any thoughts about a dividend policy?
Yep, we definitely talk about it. If you went back last year, I said to shareholders, when it came up, two general themes. One is when I talk to shareholders, they're very helpful. I get three general comments. One, and I'm being serious. One is, whatever you do, pay a dividend, don't do a buyback. Another group says, whatever you do, do a buyback, don't pay a dividend. And a third group says, whatever you do, don't give it back to shareholders. So no matter what we do, we can annoy 2/3 of shareholders. What I've said to them is, last year was give us some time because we had some investments on the horizon that we didn't know whether we'd have to make or not. So particularly at Marigold, we looked at an equipment replacement study, whether we needed to invest over $100 million to convert that red dot material to ore. Pleasingly, we haven't. There are a few other things. We'll look at Pitarrilla. So I'll probably play the same card again and say, give us till next year. At some point, absolutely, if we don't have a good place to spend it, we're not going to spend it on a corporate jet. We're not going to spend it on flying business class around North America. We will give it back to shareholders. But cash has been one of our most valuable commodities. The only reason we're able to do the investment in Silvercrest, which has been very profitable, was because they could look at our balance sheet and know that we could fund the construction of that mine if we got to that point. So something, we don't ignore it, we think about it, we talk about it internally at the board. At some stage, unless we continue to generate growth projects, we will figure out the best way to return it to shareholders.
Okay, thank you. And the last question is, talk a little bit more about the next 10 to 20 years at Marigold. How far are you to a transition in the metallurgy, and how does it look east and west?
Sure. So I think the question around metallurgy is transition from oxide to sulfide. Yes. All of our reserves and resources are oxide only. We don't worry about, we haven't got any reserve or resource in sulfide. So we've got a 10-year mine life on oxide with the additional ground and what we're drilling at the moment. I say sort of my anecdotal view is that in 10 years we'll still have a 10-year mine life. I can't, that's not a prediction, but it's just sort of a gut feel. There's still good upside potential there. So that's the oxide. The exciting thing now is the sulfide. So if you think about Marigold, this is a large, low-grade, sedimentary hosted deposit. The guys at site call it a soil anomaly. They're joking, but it's the world's largest soil anomaly, 12 million ounces. It had to have been fed from somewhere. The way these systems work is that there's a high-grade core that feeds, the gold comes up, and then spreads out over a very large area. You saw that, 5 kilometres more from top to bottom now. It's probably 10 kilometres and a couple of kilometres wide. It's a game changer and a company changer if you can find that high-grade core if it exists. It would have existed at one time, but it could have disappeared. It could have been faulted out, stoped out by a dike or something like that. But the very high-grade mines that Newmont and Barrick have across the valley, they're mining that high-grade feeder. We've done drilling over the years, and that type of drilling is expensive, a couple $100,000 a hole. Just get the years right, in 2016, we gave them some money and they were drilling. They didn't find anything, and they asked for more money. We're giving them 1 or 2 holes a year. And I just said, no, unless you can come up with a different model, this is, you're not doing anything. So they went back, got some structural geologists involved, and looked at where the original theory was that the ground hadn't moved. Then they realized that 70 odd million years ago, I think, the ground moved, and so they said, okay, we're drilling in the wrong place. So instead of drilling here, they're drilling over here. They put 3 holes in, and the last hole hit a little bit of gold, high grade, but very narrow. It was like 10 centimeters at 10 grams. We don't normally get that sort of grade. So that was interesting. What was more interesting was there was very high arsenic. Arsenic tends to be what you call a pathfinder. So the gold will stop traveling, the arsenic will travel further. So if you hit arsenic and no gold, you think you're heading in the right direction. So that was really exciting. At that point, we said, okay, stop drilling, because we were moving south on our property. And what's south of our property? Trenton Canyon and Buffalo Valley. So we had a long-term strategy, 3 years ago to try and get those properties off Newmont. The main, the value for those properties is the oxide, but it does open up the optionality. So think about the sulfide being very low probability of success, but if you are successful, it's a company changer. So we'll, we've just closed that deal. We're doing the infill drilling on the oxide resource I have at the moment, but next year we will put some money aside for continuing that deep drilling down onto that property as well. So I'd love to find sulfide, and we'll put some money into it next year.
Great, Paul. Thank you very much. That concludes the questions from the marketing and those that were emailed in or texted in. David, back to you.
Appreciate everyone's questions today, your participation on the call. Paul, great presentation. I really appreciate your conservatism and the way you're trying to balance all these other interests and investor groups. And this one, you have a great judgment, and it really came through in our call today. So I'd like to turn the call over to you for closing remarks.
Yeah, no, thank you, Em, for organising. This is a great format for us. We obviously do marketing in different parts of North America and elsewhere, but we can't get everywhere. It's just not feasible in terms of time and expense. So this is a great way to reach out. Our job is to find as many potential owners of our stock as we can. And so this is, we thank you for the format. More importantly, I thank everyone who joined in today. We appreciate your taking the time out of your day to make an investment, to think about what investments you should make. So appreciate that. If you have any questions, the details, Stacey Pavlova, her details are on our website. She's Manager Investor Relations. Any questions, send them to her. And if she doesn't know the answer straight off, she certainly knows who will have the right answer. But also, if you just want to be added to our email distribution, ask her, and you can get all our news that we send out.
We'll also be following up with everyone and be helping to add you to the SSR list as well. Thank you, Paul. Thank you to the whole SSR management team, and thank you for your participation today. We appreciate all your attendance, and wish you a very pleasant evening. Take care.
Thank you. Good night.